When Bay Street and Wall Street look at the streaming companies in particular, they see a business that grew over 30 years on large transactions, and they believe that the large transactions are over, and that's wrong. The large transactions are increasing, and I'll tell you why. Uh, Gold and silver cash flow in a royalty or streaming wrapper trades in the market at 14 or 15 times cash flow. Base metals cash flow as part of a producing company changes hands at 5 or 6 times cash flow. What that means is that the gold and silver byproduct from a copper mine is best owned by a royalty and streaming company. A royalty and streaming company can pay a disproportionate amount for that portion of the mine's revenue that comes from gold and silver rather relative to copper. The copper industry estimates, and I just heard this number in London, it surprised me. The copper industry estimates that they will need to spend $250 billion in the next 10 years to maintain current production in a market where demand is increasing at 3% compounded. In those three circumstances, the financing of base metals projects, private sector M&A, and public sector M&A, I think that the opportunities available to the streaming industry dwarf the opportunities that we've seen over the last 30 years.
You mentioned that when you were taking some profits off the table, you were trading some alpha for beta, and this have to do with the equities. And so I do want to kind of go through some of the royalty and streaming companies as you rank many portfolios, and there's many levels to this. And so I know you're a big fan of like Wheaton and Franco-Nevada and such. And so I want to start with just some of your rankings on some of these companies because they do mitigate a lot of risk. They do trade at a premium. And before we even get into the actual companies, there's this perspective that there's little to no growth in this particular sector. And so I want to get your thoughts there because I know that many of these companies have a lot of exploration projects that aren't producing assets yet. And so I want to get your perspective there.
Well, you made two great points there, Daryl. The first is that royalty and streaming companies are lower risk alternatives to exploration producing companies. The structure of the business is that you don't have a direct interest in the gold or silver mine, which means that you're not responsible for the capital cost, the operating cost, or the sustaining capital costs. You just get the money. Your gross becomes your net. From a general administrative cost perspective, too, operating gold mines is more expensive than not operating gold mines. Companies like Barrick and Newmont have huge staffs of geologists, engineers, accountants, stuff like that. The royalty and streaming companies don't have to have that because they don't operate things. So they're cheaper to operate. They're better businesses. And they're not sort of better businesses. They're way better businesses. That's important. The second point that you made is important too, which is to say when Bay Street and Wall Street look at the streaming companies in particular, they see a business that grew over 30 years on large transactions, and they believe that the large transactions are over, and that's wrong. The large transactions are increasing, and I'll tell you why. Gold and silver cash flow in a royalty or streaming wrapper trades in the market at 14 or 15 times cash flow. Base metals cash flow as part of a producing company changes hands at 5 or 6 times cash flow. What that means is that the gold and silver byproduct from a copper mine is best owned by a royalty and streaming company. A royalty and streaming company can pay a disproportionate amount for that portion of the mine's revenue that comes from gold and silver rather relative to copper. The copper industry estimates, and I just heard this number in London, it surprised me. The copper industry estimates that they will need to spend $250 billion in the next 10 years to maintain current production in a market where demand is increasing at 3% compounded. They're not talking about keeping up with demand. They're talking about maintaining current production. $250 billion. Now, the industry would appear to be, in terms of their access to free cash and credit, about $100 billion short. Where will that money come from? Lenders and streaming companies. The transactions that you will see in the future, building off out $7 or $8 billion porphyries, will mean that there will be an equity stack. Equity is part of the capital stack. There will likely be offtake capital contribution. There will likely be conventional debt. There will likely be subordinated debt, and there will almost certainly be a stream. And these transactions, the sale of precious metals byproduct streams from copper mining development, means that there are literally tens of billions of dollars of opportunity available to the precious metal streaming community from copper construction activities alone. The second facet of growth will be the consolidation of the mining industry and the precious metals mining industry. We're going to see a wave of M&A, billions and billions and billions of dollars of M&A. The cheapest form of quasi-equity is in a streaming space. And you will see, as you recently saw in the transaction where Hemlo was bought from Barrick, an important component of the compensation of the buyer to the seller will be accomplished by way of a stream. The third area of growth will be resource nationalism. Countries around the world would like to own larger parts of the producing assets within their countries. But many of the countries who desire these larger stakes don't have any money. They're precluded, often, but not always, by international convention from stealing those interests, so they have to buy them, but they don't have any money. How do they do that? Well, I suspect in the future, increasingly, there will be an accord between the company having the asset and the country that wants to own part of it, where the divesting company will finance the national interest partially by way of the sale of a stream. So in those three circumstances, the financing of base metals projects, private sector M&A, and public sector M&A, I think that the opportunities available to the streaming industry dwarf the opportunities that we've seen over the last 30 years.
So let's go ahead and go through some companies, and I just want to get your idea for your rankings. You rank a lot of portfolios and such, and so you all be sure to submit your portfolios to Rick at ruleinvestmentmedia.com so that he can rank your portfolio. He's done thousands of rankings, and so let's start with some of the tier one companies. So I want to get your ranking on Franco, Wheaton, and Royal Gold.
For the record, today's interview is taking place on the 17th of December. I say that because rankings are ephemeral. They're a snapshot in time. Something could happen in the news 4 weeks from now that completely obviate my ranking. So don't watch this discussion in June of 2026 and think that the ranking is current. Now let's get back to the question. Franco-Nevada is the best of the best, the finest precious metals investment on the planet. Despite the fact that it's done extremely well, I have it as a 4. Rankings are 1 to 10, 1 being best, 10 being worst. For the record, I've granted 11 number 1 rankings in 35 years of ranking stocks. A one ranking is extremely rare. Wheaton, I also have as a 4. Very, very, very high quality company. No longer silver centric, but still about 40% of its revenues silver related, which means that the financial results in the future, given the doubling of the silver price over the last 12 months, will surprise people whose expectation is rooted in the past. What were the other names? I'm sorry, Daryl.
Royal Gold.
Royal Gold I just upgraded to 4. It has sold off a bit as a consequence of the Sandstorm acquisition, which I believe was a good acquisition. My hesitancy around Royal Gold used to be the concentration of the company on a very few assets and the weakness in its midstream growth. It obviated both of those concerns with their recent transaction, so I have it as a 4 as well.
Okay. So obviously the risks are a lot different for these companies. These companies are, I mean, multi-billion-dollar companies. They're the biggest and the best. Let's go down another tier. Let's talk triple flag.
I have triple flag as a 4 with a temptation to upgrade it as a 3 as a consequence of price performance. Triple flag is what I would call a mini major. There's a tier of companies below the majors. Triple flag is at that space. Much more systemic risk than the big companies because they have fewer tier one assets, which means that their revenues are unstable. It also means that it's easier to grow them, and they're selling at lesser multiples. I have triple flag as a 4. I'm very positively inclined to triple flag, and I've been adding it to my own personal portfolio.
Okay. Then we have Aura Royalties, formerly known as a Cisco royalties.
Uh, Probably on fundamentals, the cheapest of the majors. Two tier one deposits, which means that you don't have the same reliance on tier two or three or tier three deposits. Also, what looked expensive but turned out to be a relatively fortuitous acquisition of the royalty portfolio of Orion, which is to say, at the point in time that they bought it, they paid a very full price. Then the gold price doubled
Hmm.
and made that acquisition look much more attractive. Again, I have it as a 4.
Yeah, it's hard to get past the 4. So triple flag is the only one that's potentially going to be upgraded to 3. Just depends.
Listen, if the prices of any of them get weak, understand that this is a function of price to value. If
Yeah,
the price goes down, which scares people, it excites me. A
yeah.
bear market is a sale. It would be easy in market weakness to see this whole sector upgraded to a 3.
Hmm. Got it. Okay, let's go down the chain a little more. So here, obviously, the companies are younger, newer, smaller, and such, and so obviously there's a little more risks there. But let's get in it. So Elemental Altus.
I'm going to go out on a limb. The stock has done well. I have Elemental Altus as a 3.
3.
You have seen some price weakness as a consequence of some Elemental shareholders selling and some EMX shareholders selling. That has been offset by a private infusion of $100,000, $100 million, pardon me, into Elemental Altus by Tether and the promise of access to more capital should the company need it. I believe there's going to be a consolidation of the tier three space. And I believe that the finest of the tier three royalty companies is Elemental Altus. In addition to having access to capital and the discipline to make intelligent acquisitions, through the EMX side of Elemental Altus, the company has the ability through prospect generation to create their own royalties, not to have to buy them, but in fact to make them. I
Mm.
note with some pride that I'm a founding shareholder of EMX. That is, I owned it pre-public. And I was a founding shareholder of Altus, one of the roots of Elemental Altus. So I go back with this company 25 years, and I can speak with real fondness as to the corporate culture on both sides of the merger.
Okay. Yeah, that's good to know. So sticking along that same line of Tether taking investing in multiple streaming companies, we have Tether recently invested into Metallo Royalty and Gold Royalty. So I want to get your perspective on those two.
I have Metalla as a 5, and I have gold. Well, I have Gold Royalty as a 5 now, as a consequence of recent share price escalation. They're both fine companies. They're both companies that the market has treated fondly. I should tell people that my 5 and above rankings, despite the fact that 5 is a middle of the road ranking, my 5 or above rankings constitute 25 or 30% of my over rankings population. So a 5 might appear to the normal person to be a neutral. I personally own many 5s.
Hmm. Yeah, I mean, it just speaks to like there's no perfect company. I mean, it's very rare. I mean, I think Ivanhoe was the one for you like a long time ago, and you did really well with Ivanhoe and Robert
Yeah,
Friedland,
it
and
speaks to the fact that I'm an old cynic and I'm a very harsh grader.
yeah, yeah, for sure. Yeah, that's good. So let's talk about Empress.
I have Empress as a 5. I recently downgraded it from 4 simply because the stock has performed so well. I love the
Yeah.
company. I own lots of it. I bought it because it was selling at half of its intrinsic value, and I believe that they had a definitive competitive advantage with their relationship with Endeavor Financial. Endeavor Financial, for those of you who don't know, is one of the premier financial arrangers for mine construction development worldwide, and having access to the capital stacks constructed by Endeavor Financial is the durable competitive advantage that Empress enjoys. In addition, Empress enjoys access on an as needed basis to the technical staff at Endeavor Financial, meaning that unlike its other peers, Empress doesn't need to employ full time geologists and engineers, but rather accesses them for pay as needed. These are
Mhm.
big advantages.
Yeah, yeah,
Those
that helps a lot with the G&A costs, right?
those big advantages are compounded by a very focused, very smart CEO. The reason I downgraded the company from 4 to 5 is simply because the share price is up 400% since I bought it.
Yeah.
Rankings are always a function of the juxtaposition between price and value.
hmm Yeah, yeah, for sure. I remember engaging with Alex and Empress the first year at your symposium. That was back in the first year I went, which was in 2023, and I think they were trading at a little less than 30 cents at that point. And so, yeah, the performance has been amazing.
Corporate performance has been good too. Uh, it's just not as cheap as it was then.
Yeah, agreed. I wish you would have nudged me and like load the boat, Daryl, load the boat. I wish
Well,
you
I
would
was
have nudged
trying
me.
at that point in time, Daryl. I was trying to get you to load up on beta, not alpha. I want to take a young man who had to who had to provide for his son 30 years from now, and I didn't want you to take any risks at all. So
Yeah, yeah,
the
for
Daryl
sure.
Thomas that's in front of me today with a new career and a new net worth is somebody who I'll push a little harder in the future.
All right. I'm ready for it. I'm ready. Okay, so Origin. This was a company that you ranked on one of our episodes a long time ago. Was about what, a year or so ago, year maybe 2 years ago, and I think you had them at a 2 back then. And
I did.
the
I did.
performance just was amazing since then and such. And so, just curious in your perspective on them now.
A couple of years ago, they owned the silica cap royalty, a royalty on a deposit in western Nevada that was shaping up to be a 10 million ounce or greater deposit. It was very clear to me that that deposit by itself was worth a substantial premium to the whole of Origin. And the whole of Origin also had another producing royalty, the Ermitaño. I believed at the time that the Ermitaño royalty was worth the whole market cap of Origin, and that the rest of their portfolio was worth half to two-thirds of the market cap of Origin, and that the Silicap royalty was worth twice the market cap of Origin, which is to say that I believe that the company could be broken up for 350% of the then share price. That's a pretty good deal. That's before any gold price escalation. And that's what happened.
Yeah,
Uh,
yeah.
they sold off the Silica Cap royalty. Huge win for shareholders. And they spun the rest of the company into the new Origin. The value proposition is less extreme now, but again, you have an experienced, honest team who doesn't have to buy royalties, but rather they create them. In particular, their future is in their own hands because the Ermitaño royalty generates enough money to sustain the company, earn a profit, and distribute a dividend while they grow.
Okay, got it. And so this company, the next company, I'm not as familiar with. Our mutual friend Benjamin mentioned them when I was having a discussion with him recently on the performance of the royalty and streaming companies. But Ecora Resources.
Yeah, Ecora has been a continued participant in the Natural Resources Investment Symposium, and it's a royalty company that I've owned for about 10 years. It's London listed, which has traditionally been a bit problematic because there wasn't a market for royalty and streaming companies in London, and the assets were non-London. They've addressed that with a North American listing, a Toronto listing. The other knock about it was that most of the revenues came from coal. That's a double-edged sword. What it meant is that they were enjoying a lot of free cash flow, and the market hated that cash flow. I didn't, but the market did. The strategy was that the company would use that coal cash flow to diversify into non-coal royalty streams, which they did with spectacular success. They built a portfolio of both producing and soon to be producing and non-producing royalties that, relative to the price of the whole, relative to the market cap, was and arguably is still the cheapest in the space. The company has performed very, very well, but given the fact that the cash flow is derived mostly from materials other than gold, that cash flow hasn't been valued as highly as precious metals royalty and streaming companies have. The flip side of that is, like a different company in the same space, Altius Minerals. This company has access to a much broader range of royalties and can acquire cash flows at a much less extraordinary royalty while still enjoying the structural benefits that royalty and streaming companies have in commodity production. I have Acora as a 4.
4. Okay, then what about Altius?
I have Altius as a 4 with a potential upgrade to a 3. These guys are superb allocators of capital. What has been a drag on Altius, well, Altius had a huge benefit not too long ago from selling part of the same royalty that Origin did, and enjoying a $230 million win on a $1 million investment
Mm-hmm.
win. What has been a drag on Altius is that they have spent a lot of money on royalty and streaming investments in alternative energy and wind and solar. And these are long lead time investments. So the money has been out without the money coming back in. Much more recently, the money's begun to come in spades. And I think that the free cash flow that you see in Altius over the next 2 years from their investment in so-called green energy, by the way, not operating investments. They don't have the capital cost, all that kind of stuff. They don't have the operating costs. They just get the money. I
Yeah.
think what you're going to see is increasing free cash flow, increasing return on capital employed, and also more clarity in the market about the relationship between the way you invest in alternative energies and how you get paid.